Retail holders have defended XRP as the dormant titan of digital finance for years. However, something noteworthy is taking place today. Chat rooms and cryptocurrency forums are giving way to the glass skyscrapers of Wall Street as the focal point of the discourse. The same giants who are reshaping traditional finance, major asset managers, are now investigating digital assets as infrastructure rather than as speculation. XRP, a coin designed for international payments, lies at the heart of this change. The question is not whether BlackRock and other institutional investors will enter the market, but rather how they will do so and how price discovery will be affected. In addition to paving the way for mainstream investment, BlackRock's first Bitcoin ETF gave digital assets legitimacy in the eyes of the biggest capital pools in the world. A single ticker symbol might abruptly expose trillions of dollars in insurance, sovereign wealth, and pension fund holdings. Wall Street learned a valuable lesson from that achievement. Regulation comes after clarity, and liquidity comes after regulation. Diversification beyond Bitcoin is the next logical move as new frameworks come into being. Analysts are already debating what will happen after the Bitcoin ETF era, and XRP is at the top of their speculative wish list because to its practical applications and institutional-grade settlement technology. XRP differs from its predecessors, which were speculative assets. It is intended to connect fiat, not to replace it. Financial organizations transfer trillions of dollars across borders every second using cumbersome, slow networks. The ledger of XRP can settle those identical payments in a matter of seconds, almost for free, and with energy efficiency that is appropriate for the ESG-driven investing environment of today. Wall Street finds it impossible to resist the combination of speed, cost, and compliance possibilities. Because of this, commentators refer to XRP as an infrastructural asset rather than just a coin. Although the idea of an XRP ETF may seem futuristic, the reasoning behind it is actually rather simple. There is virtually no fundamental reason why institutions couldn't eventually create products based on other compliant digital assets if they are able to custody and hedge Bitcoin and Ethereum through regulated vehicles. Custody has always been the missing component. Companies like Coinbase Institutional, Fidelity, and BNY Mellon are vying to offer safe, legally approved storage for tokenized assets. The Wall Street machinery, fund products, derivatives, and loan markets can all come to life very immediately if institutional custody of XRP is completely standardized. The function of XRP changes from retail speculation to liquidity provisioning inside that future framework. Consider it plumbing for financial gain. Every on-chain fund, tokenized bond, and exchange-traded fund still requires a way to settle value. The figures become remarkable if XRP even manages to get a little portion of that market. Over $150 trillion is spent annually on cross-border settlements worldwide. On-ledger demand of hundreds of billions would result from capturing 1% of the flow as transactional liquidity. This value mechanism is a talking point in boardrooms when applied to a fixed supply of 100 billion tokens. For this reason, a lot of commentators predict that 2025 will be the year that institutional investors finally realize what early proponents of XRP have been saying for 10 years. That long-term value is defined by utility rather than speculation. Instead than chasing hype, wise money tracks settlement volume and cash flow. The demand for effective bridges increases as the world tokenizes assets and payments. XRP is already designed specifically for such use. The research teams at BlackRock have openly recognized that tokenization is the way of the future for all financial assets. Larry Fink has frequently discussed how markets are becoming digital, with blockchain technology supporting everything from stocks to real estate. The infrastructure he is describing sounds remarkably similar to what the XRP ledger already offers, even though he has never recommended any particular commodity. Compatibility with compliance, speed, and interoperability. It makes sense that bridge assets like XRP would be examined, modeled, and maybe included if and when big asset managers start building diverse token portfolios. The story then starts to reinforce itself. Institutional participation increases, liquidity deepens, and volatility decreases as soon as significant funds commit even a small portion of their holdings to settlement layer tokens. The clarity these businesses need is already provided by regulatory frameworks such as the UK's post-Brexit crypto policy and Europe's MiCA. The US will probably do the same, allowing registered goods to hold assets related to digital infrastructure under stringent disclosure regulations. Then consider the ripple effects. Pension managers, endowments, and sovereign wealth funds can hold XRP exposure without interacting with unregulated exchanges thanks to a transparent regulated ETF or trust structure. That one adjustment creates trillions of dollars in fresh demand. Network usefulness increases with each new level of involvement, from custodian banks to hedge funds. Similar to how traditional commodities are valued based on supply-demand dynamics, the market begins to value XRP based on transaction throughput, liquidity depth, and interoperability indicators rather than speculative excitement. 4 or 5-figure valuations are not a pipe dream in that scenario. It is a mathematical representation of increased use. The capitalization of the entire cryptocurrency business today is actually dwarfed by the size of the global payments market. Assets that facilitate settlement flows will be revalued to reflect their systemic significance as they move up the chain. The amount of tokens, 100, 1,000, or $10,000, depends on the rate of adoption and cycles of liquidity. However, the idea remains the same. Utility trumps value. Retail investors perceive this institutional awakening as abrupt. It seems inevitable to many who have spent years studying the XRP ledger. The XRP Army has been discussing regulatory readiness, ISO 2022 integration, and bank relationships for 10 years. These stories are now coming together with the desire of mainstream finance for practical blockchain applications. This is the well-known tale of early conviction, fulfilling validation at the late stage. Retail investors have a front-row seat to one of the most significant shifts in financial history, as Wall Street's research teams analyze liquidity data and simulate the settlement flows of digital assets. Digital gold and memes won't be the focus of the upcoming generation of ETFs and structured products. They will focus on how value is moved behind the scenes by digital railroads. The true message is more straightforward, even though headlines may highlight figures, $10,000 forecasts, or trillion-dollar market valuations. The usefulness of blockchain technology is now being acknowledged by institutions, and XRP's architecture matches the networks they will require. The systems that could make it happen are being studied, tested, and covertly constructed by financial power centers. The era of conjecture is coming to an end. We have entered the age of integration. The distinction between blockchain and traditional finance will become increasingly hazy when Wall Street's algorithms eventually link to decentralized liquidity pools and ETF custodians begin completing cross-border settlements in seconds rather than days. Bridge assets like XRP are prepared for that scenario. It's infrastructure, not hype. Disclaimer. Please keep in mind that I do not hold a financial advisor license. These videos' content is solely intended for viewing enjoyment. Before making any financial decisions, I always advise viewers to do their own research and speak with experts. Many thanks for listening. Please remember to hit the subscribe button and give the video a thumbs up if you liked it. Additionally, to be the first to know when I post new stuff, make sure you enable the alerts. I can't wait to see you again in the next video. Be careful.